Silver's kind of acted on its own, whereas gold was down massively. Oil obviously is a big thing. The Strait of Hormuz is effectively closed, and that could change at any moment. And that's going to be a big deciding factor when we see these markets pivot. Personally, I think silver is headed higher. This is the next minor level of resistance at 87.51, and it's at 86.98, so not that far. And then, of course, this is major resistance at 97 to $100 per ounce. I think silver's moving higher. I've heard some analysts saying it's going to 150 or higher. I pray they're wrong. In terms of gold, there's very strong support at 5,000. When we look, I've got gold on both sides, sitting just below 5,100, and that is where I am pegging a major level of support. This all has to do with the Strait of Hormuz. Yes, 20% of the oil comes out of global production, comes out of the Strait. Investors and traders believe that the recent downside in gold was due to technical selling. That explains some of it, but it's why they were technically selling. And that is in times of crisis, one, specifically with oil moving higher, and the chance that the Fed is not going to be as accommodative with rate cuts, they seem to be moving large amounts of gold back into dollars. Mm-hmm. And we've seen that in dollar strength. We've seen that in the decline of gold. Silver's kind of acted on its own, whereas gold was down massively yesterday in Australia and has recovered at least 50%. Silver's tugging along and actually trading higher on the day. Yeah. The question is, excuse me, if this is going to be a short event or an elongated, protracted event, because each of those scenarios carries different possibilities in terms of where we're going to see the metals move, the dollar move, and specifically oil. Oil obviously is a big thing. The Strait of Hormuz is effectively closed, and that could change at any moment. And that's going to be a big deciding factor when we see these markets pivot.
Yeah, yeah. And I mean, fundamentally, obviously, we know we can't predict what's going to happen today or tomorrow. But I mean, from a technical standpoint, if we can't hold this $5,000 handle, I mean, I think your points back the last time we had you on was about $4,800 as the next structural support.
The market keeps blaming technical selling, but the real driver is capital quietly fleeing risk. As Gary Wagner points out here, gold weakness isn't just chart noise, it's money rotating into the dollar as oil spikes and traders rethink whether the Fed will actually cut rates this year. A stronger dollar plus geopolitical tension near the Strait of Hormuz creates a strange setup where gold falls even while global risk rises. That contradiction usually signals liquidity stress building beneath the surface. Next, Gary Wagner discusses the key price levels that reveal whether this sell-off is temporary or the start of a deeper reset.
I mean, conversely, we have that volume dominator resistor kind of at 51.95. I mean, on a daily closing basis, which of those levels is the market kind of telegraphing right now?
Well, in terms of gold, there's very strong support at 5,000. When we look, I've got gold on both sides because I want to put different studies up later if time permits. But we've seen gold wick down to 59 or 5,011 here, and then here to 5,024. But the real bodies, meaning, excuse me, the relationship between the open and closing price on a candlestick, of course, if it's red, it means it closes lower. Green means it closes higher. But you've had these bodies sitting just below 5,100, and that is where I am pegging a major level of support. I tend not to count the wicks because these are unsustainable lows on the downside or unsustainable highs on the upside, as we see right here. So I look for where the real bodies are either opening or closing, and it's right below 5,100.
Yeah, good point. I mean, I guess we could crack that open a little bit more. I mean, you and I have talked about this before. I just came back from a trade show where everyone was talking about these daily prices. $10 silver in one day would have been some big news back in the day. And conversion, like $5,000 gold to 5,200.
Headlines focus on wild intraday swings, but serious traders watch where the market actually closes. As Gary Wagner points out here, the real support zone isn't the dramatic spikes or panic lows, it's the cluster of closing prices sitting just under $5,100. Those candle bodies reveal where institutions truly transact, filtering out emotional moves driven by algorithms and stop-loss cascades. In today's high liquidity markets, ignoring those fake extremes can mean the difference between spotting accumulation and mistaking noise for a breakdown. Next, Gary Wagner talks about whether these rapid price recoveries signal a healthy bull market or a dangerous technical pattern forming.
That was just today. So, I mean, in your experience, do these rapid recoveries lead to sustainable new highs, or are we just building a massive head and shoulder pattern that spells trouble for the next few months?
Well, it depends on the macro geopolitical environment that gold is trading within. Because when you think about it, and this all has to do with the Strait of Hormuz, yes, 20% of the oil comes out of global production, comes out of the Strait. But for a country like India, 40% of their oil comes directly from Iran. China, 40% comes from Iran. And so it has the ability to affect the global economic macros in a much more intense way than if it was another commodity or something else was at play. It is a challenging time, absolutely. And I think that as long as this is not a sustained conflict, as long as this resolves itself within a week or 2 weeks, things will pivot and go back to the way they were. If it moves much further, 3 weeks, a month, or months, God forbid, then all bets are off in terms of having a soft landing, so to speak, because an extended conflict would mean so much damage could occur economically for countries across the world, let alone the tragedies that are happening in different parts of the world right now.
Most investors treat oil shocks as temporary headlines, but history shows they can reset entire economic cycles. As Gary Wagner points out here, roughly 20% of global oil flows through the Strait of Hormuz, meaning even a brief disruption can ripple through inflation, interest rates, and corporate margins worldwide. Countries like India and China, relying heavily on Iranian supply, amplify that vulnerability, turning a regional conflict into a macroeconomic risk. If oil surged toward $150, like some analysts warn, it would pressure central banks and crush the soft landing narrative markets still price in. Next, Gary Wagner unravels what this geopolitical tension could mean for silver's surprising strength.
Yeah. If you look at silver, I mean, Gary, it's up today. So is that telling you the market has better internal strength than gold right now, or is this just a short covering bounce inside a weaker structure?
This is certainly not a short covering bounce. What I did, what was interesting, and I'll see if I can get this up. I should be able to. Fib retracement. So if I do a Fib retracement from silver when it's at 48.50 up to the high of about 121, what we're going to find is, and let me move these averages up. What you'll find is the market comes down, and then it really goes between a 61 and a 78% correction. That's an extremely deep correction. But then considering that silver moved from $46 to 121, a deep correction can be expected. The interesting thing is if I do a Fibonacci retracement from this low here, this wick, to here, this is also about a 61.8% retracement. So we're seeing deep corrections, but in all cases, these corrections are acceptable in terms of they don't represent a pivot from bullish to bearish, but rather a correction within a bullish market that is still sustainable. And that's what I find is interesting right now.
Yeah, I mean, so the bid is coming back. I mean, does that tell you that buyers were waiting at lower levels all along? And
A brutal correction doesn't always mean a bull market is broken. Sometimes it's simply the market catching its breath. As Gary Wagner points out here, silver's pullback retraced roughly 61 to 78% of its explosive rally from $46 to $121, a deep but technically normal Fibonacci correction. Markets that recover quickly after such drops often reveal hidden institutional demand stepping in beneath the surface. That's the part rarely highlighted in headlines. Corrections can actually confirm strength when buyers aggressively defend key levels. Next, Gary Wagner discusses whether this rebound signals real accumulation or just another temporary bounce.
and I mean, what would confirm that this is real accumulation rather than just a reflex bounce?
What tells you that it's not a reflex? If the market would have made this major move up to 120 and then fell down to, I think, $64, roughly in half in a short period of time. If it was just a bounce or something, we would have seen sideways trading, meandering lower. But the fact that it recovered about 50% of the drop tells me it wasn't just a bounce, because you got buyers coming in at this bottom and aggressively moving the market higher.
Tell me a little bit about the DXY, Gary. I mean, we're hearing about it today. Obviously, dollar showing quite a bit of support. I mean, right now, when you're looking at this in terms of the metals complex, I mean, you're starting to see some trends here.
So let's consider that the bottom of the dollar short term, I can move this down a little bit, but came down at around 95.58. That's the dollar index. And then it's moved up hugely, 2-3%, where we've seen this tremendous move. And this is the point in which gold was really getting pushed down to lower prices. You typically don't see big moves like this on the dollar.
A quiet shift in the dollar can crush entire commodity rallies before most investors even notice. As Gary Wagner points out here, the US dollar index jumping from roughly 95.5 to near 99 represents about a 4% surge. A massive move in currency markets, where daily shifts are usually fractions of a percent. That strength helps explain why gold suddenly sold off, even as geopolitical tensions rise, a contradiction many headlines ignore. When the dollar rallies this quickly, it often signals global liquidity tightening beneath the surface. Next, Gary Wagner discusses why this unusual dollar move could reshape the metals trend in the weeks ahead.
Typically on the dollar, you have these smaller candles because currencies don't tend to have wild swings against the basket of currencies that they're being traded against. And the dollar index is really compared to 8 other currencies, euro being the primary one, I believe, encompassing 54%, but you've got the British sterling in there, you've got Japanese yen, you've got Swiss franc, Swiss krona, other things. So these moves are highly exaggerated moves. And so we have seen the dollar, move back up to almost 99. So when you consider 95 to 99, that is a 4% jump, an increase of value relative to the other currencies of in the short time of a couple of months.
Yeah. So
that's a fast move.
That is a fast move. And I mean, you're looking at the metals. I mean, over the next few weeks, is your best or your base case kind of that gold holds its correction and pushes to fresh highs, or do you see a kind of a bit of a deeper reset before the bull trend resumes? What's that number like?
Well, I mean, unquestionably, this market has been on fire. If we look back to August 2025, it's sitting at 3,300. And from there, it tops out at 5,600. Thousands of dollars in terms of gains. And then in a couple of days, a lot of it was given back.
Currency markets rarely move fast unless something deeper is shifting in global capital flows. As Gary Wagner points out here, the dollar index climbing from 95 to nearly 99 in just a few months represents roughly a 4% move against a basket dominated by the euro, which alone carries over 50% weighting. That's unusually aggressive for currencies and often signals institutional repositioning rather than retail trading. When that happens, commodities like gold frequently correct even during strong long-term bull trends. Next, Gary Wagner talks about whether the recent gold pullback is a normal correction or the start of a deeper technical reset.
And so the way I'm looking at it, we are definitely still in a correction. The question is, was the correction this brutal and quick, and now we're getting the recovery here? Or if it's like what we call an ABC correction, where you get your first wave down as your A, then your next wave up is your B, your final C will take you back down. How is this particular scenario going to unfold? And in this case, markets always move based on fundamentals. Technicals simply tell us where they've been, and therefore we can ascertain where they might go. But we are at a critical point in terms of gold, whether it's going to hold these levels and move higher off that, or if it will complete that ABC correction and have one move lower. Right now, the strength of this uptrend, even though it sold off pretty hard back on Wednesday, the 4th of March, it's even recovering from that. And then even when you look at like today, and you see that the lows came in at around 5,032, it's $120 off of that at 51.52. So we're seeing some real resilience. And as you had mentioned, Trump said some news, and I'm not privileged to what was said because I was getting ready for this interview, but statements that are going to offer hope that this conflict is coming to an end quicker than later.
Sharp sell-offs often scare investors out right before the market decides its next real direction. As Gary Wagner points out here, the current gold move could simply be part of a classic ABC correction, where one more decline completes the pattern before the broader bull trend resumes. After all, gold surged from about $3,300 in August 2025 to roughly $5,600, a massive rally that historically invites deep but temporary pullbacks. What matters now is whether the market holds around the $5,000 region or breaks it decisively. Next, Gary Wagner discusses what signals might confirm a real recovery versus another leg lower.
Are going to have the unwinding effect that we've seen come in as this conflict developed.
Yeah. And happening fast, I may say. It's hard to keep
Absolutely.
up with. So thanks for making the time, Gary. And also, well, let's ask silver too. I mean, just to get a little wrap up on that. I mean, do you kind of expect this rebound bid to carry into a stronger recovery from here, or is the metal still too vulnerable to add that other leg up?
Personally, I think silver is headed higher. It's broken above. This is the next minor level of resistance at 87.51, and it's at 86.98, so not that far. And then, of course, this is major resistance at 97 to $100 per ounce. I think silver's moving higher.
Interesting. Anything that you think we should be watching for that you found interesting in this past few weeks that just goes, oh, there might be more to this story?
The one thing that investors and traders want to pay attention to more than anything is the price of oil. And watching if and when, well, it's going to be when, but when we get a point where that crazy volatility comes out, as you said, it was trading at 120 a barrel and then broke back through 90 all in one day.
Silver quietly breaking resistance often signals something bigger happening beneath the surface of the metals market. As Gary Wagner points out here, the metal pushing toward the $87 to $100 resistance zone suggests buyers are stepping in earlier than many expected after the recent correction. Historically, silver tends to move later, but faster than gold during strong commodity cycles, which makes these technical breakouts worth watching closely. The real wildcard, however, remains energy markets. Oil's extreme volatility can rapidly change inflation expectations and investor positioning. Next, Gary Wagner talks about why oil prices may be the single most important signal for markets right now.
Yeah.
I've heard some analysts saying it's going to 150 or higher. I pray they're wrong, because that says all kinds of repercussions globally, because everything is dependent on the energy that provides, whether it's running companies, whether it's running factories, whether it's running transportation. That's a critical component of our daily life in society at this point in time. So that's what we want to watch, because it seems that oil is setting the precedent for what the other markets do. Whether the stock markets globally recover, it's, I believe, going to be highly based upon oil prices stabilizing and moving back into acceptable levels. If they maintain, if oil maintains the price back above 100, that's when economies have issues, and that's when we see things breaking down. So that's what you're going to want to watch. That's the leading indicator in my mind to what the rest of the stocks, equities, commodities, the asset classes are going to do in terms of the price over time.
When oil prices surge, the ripple effects reach far beyond energy stocks and gasoline bills. As Gary Wagner points out here, oil acts as the foundation of modern economies, powering transportation, manufacturing, and nearly every supply chain that feeds corporate earnings. If crude were to climb toward $150, inflation pressures would likely spike again, forcing central banks to keep interest rates higher for longer. That scenario would strain equity valuations and corporate margins simultaneously.